Imagine you are at the absolute peak of your career.
Right, making great money.
Exactly. You are making great money, maybe looking ahead to an early retirement, and suddenly you inherit a $2.5 million IRA from your parents.
Sounds like a dream, honestly.
I mean, it sounds like the ultimate financial windfall, right?
Hmm.
But what if I told you the IRS has a hidden trap waiting that could legally confiscate almost half of that money in just 10 years?
Yeah, that is the nightmare scenario.
It really is. So, welcome to a very special deep dive for the 1715 Treasure Coast Financial Wellness Podcast. Today, we are opening up a comprehensive guide from Davies Wealth Management. They are a fee-based fiduciary advisor located in Stuart, Florida.
Great firm.
Yeah, and our entire mission today is to map out the minefield of the new inherited IRA rules taking effect in 2026 and cover the 7 critical strategies every beneficiary absolutely must know.
What's fascinating here is how quietly this massive change happened, because for decades we had this concept of the stretch IRA.
Right, where you could just stretch it out forever.
Basically, yeah. If you inherited retirement money, you could stretch the tax burden out over your entire expected lifespan. It was incredibly forgiving.
So if you inherited it at 30, you had 50 years to slowly pull it out.
Exactly. But the government realized they were waiting way too long to collect their tax revenue. So they passed the Secure Act, the Setting Every Community Up for Retirement Enhancement Act.
Wow, they love a good acronym.
They really do. But despite that friendly-sounding acronym, it essentially ripped up the old playbook. They eliminated the lifetime stretch for most people and forced a massive acceleration of taxes.
It's kind of like the government traded in a garden hose for a high-pressure fire hose.
Oh, that is a perfect way to put it.
Because under the old rules, taking distributions was like sipping water from that garden hose.
Yeah.
It was manageable, it was slow, and the rest of the account just kept growing tax deferred in the background. But now, if you inherit an IRA from someone who passed away on or after January 1st, 2020, they've turned on the tax-heavy fire hose. And you are forced to drink the entire account dry by December 31st of the 10th year following the owner's death.
And that 10-year clock is merciless, but it actually gets worse.
Wait, worse than a 10-year deadline?
Yeah, much worse. Many taxpayers and advisors initially looked at that 10-year rule and thought, okay, we have 10 years. I'll just leave the money in the account to grow, totally tax-deferred, and I'll just take one massive lump sum withdrawal in year 10.
That makes sense. Push the tax bill off as long as possible.
Right. But in 2024, the IRS threw a massive curveball. They clarified that if the original owner of the IRA was already taking their required minimum distribution.
Which, just looking ahead to 2026, generally kicks in after age 73, right?
Exactly. If the original owner was already taking those RMDs, then that momentum cannot stop. The beneficiary must also take annual mandatory distributions during those 10 years.
Oh, wow. So you can't just wait until the end.
No, you absolutely cannot. The IRS forces you to take money out every single year.
Okay, let's unpack this for a second. Does this fire hose apply to literally everyone? What if I leave my retirement accounts to my spouse or maybe my young kids? Are they forced onto this brutal 10-year timeline too?
No, and that is a crucial distinction. The IRS did carve out exceptions for a group they call eligible designated beneficiaries, or EDBs.
Okay, EDBs. Who falls into that?
If you fall into this specific category, you are shielded from the strict 10-year rule. Surviving spouses are the biggest group. They can generally treat the IRA as their own.
Makes sense.
It also includes minor children of the deceased. But, and this is a big but, the catch there is that the protection only lasts until the child reaches the age of majority.
Oh, so the day they turn 18 or whatever the legal age is in their state.
The day they become a legal adult, that 10-year clock immediately starts ticking. The rules also protect individuals who are disabled or chronically ill and beneficiaries who are not more than 10 years younger than the deceased, like a sister or brother.
Okay, so a fairly narrow group.
Very narrow. For everyone else, especially healthy adult children who are by far the most common beneficiaries, that 10-year fire hose is the absolute reality.
Right. So let's put you, the listener, right inside the scenario outlined in the Davies Wealth Management Guide. Let's look at the actual dollars and cents, because this is where the wealth compression trap really snaps shut.
The math gets pretty ugly.
It really does. So let's say you earn $450,000 a year. You are doing well. Then you inherit this $2.5 million traditional IRA. You think, well, I'll be smart. I'll spread this out evenly over the 10 years to soften the tax blow.
Which is what everyone tells you to do online.
Exactly. But that means you are pulling out roughly $250,000 a year.
And this is exactly where generic internet advice fails spectacularly, because for an average earner inheriting a small account, spreading it evenly makes perfect sense. But in your scenario, adding $250,000 of ordinary income on top of an already high salary triggers a violent domino effect. First, it shoves your income firmly into the top 37% federal tax bracket.
Wow. And for married couples filing jointly in 2026, that top bracket kicks in around the, what, $750,000 mark?
Yep, right around there.
Which means the government is taking 37 cents of every dollar you pull out of that inherited account past that threshold.
Exactly. But the dominoes keep falling. We have to look at a concept called AGI, or adjusted gross income.
Right, the magical AGI number that drives everything on your tax return.
Yes. Your AGI is basically your total income before standard or itemized deductions. When your AGI artificially spikes by $250,000, it acts like a weed killer on your other tax benefits.
A weed killer.
Yeah, it reduces or completely eliminates your AGI-based deductions. Furthermore, crossing certain high-income thresholds triggers the net investment income tax.
The NIAT.
The NIIT, exactly, which is an extra 3.8% penalty on your other investment earnings. So the inheritance is actually causing your other money to be taxed higher.
Oh my gosh, that's rough.
When you add federal taxes, loss deductions, and investment surcharges, the total marginal tax rate on that inherited IRA money can easily exceed 40 to 45%.
That is wild. I mean, it turns a family legacy into an unavoidable tax nightmare.
It really does.
So if the generic spread it out evenly advice is catastrophic for high earners, how do we actually manage the income curve? Like, how do we diffuse this immediate tax bomb?
Well, strategy 1 in the guide is that it requires choreographing your tax brackets with surgical precision. The very first thing you have to do is map out your projected income for the entire 10-year window.
Okay, so you're looking ahead for the whole decade.
Right. You do not want a flat withdrawal rate.
Well,
you are looking for valleys in your income curve. Are you planning a sabbatical? Are you between selling a business and starting a new one?
or maybe you are retiring at 62 but delaying Social Security until 70.
Exactly. Those are your low-income valleys. You want to accelerate your inherited IRA distributions heavily in those specific years to fill up the lower tax brackets and then pull back to the bare minimum during your peak earning years.
So what does this all mean if I'm simultaneously trying to optimize my own retirement accounts? Strategy 2 mentions Roth conversions, because a lot of people are doing Roth conversions on their own portfolios right now. How does that fit in?
It becomes a really complex balancing act. Because both actions, taking money from a traditional inherited IRA and converting your own traditional IRA to a Roth, both of those generate ordinary taxable income.
Right. They both spike your AGI.
Exactly. So you have to coordinate them. In a high-income year, you might halt your personal Roth conversions entirely so you have room to absorb the mandatory inherited distribution.
And then in a valley year.
In a valley year, you have to decide, do I use this low tax bracket to pull money out of the inherited account, or do I use it to convert my own money to a Roth? You are managing a combined tax liability across all accounts, not just treating the inheritance in a vacuum.
Which naturally leads us to strategy 3, the philanthropic escape route.
Yes, charity.
Because if this money is going to be taxed at 40% or more, maybe we just don't take it as income at all. The Davies guide dives into charitable options, mentioning things like donor-advised funds and charitable remainder trusts.
They are incredibly powerful tools.
But wait, I have to ask the obvious question here. If I take the money my parents left me and give it away to charity, aren't I just giving away my inheritance so I don't have to pay the IRS? How on earth does that help my own family's bottom line?
It's the most common pushback we hear, and it's completely valid. The key to understanding this mechanism is that it is designed for people who are already charitably inclined.
Okay, so people who are already donating.
Right. Let's say you normally give $50,000 a year to your university or your church out of your regular salary. Instead of doing that, you set up a donor-advised fund, or DF.
A DF, okay.
You take a massive, heavily taxed distribution from the inherited IRA, say $250,000, and you dump it straight into the DF.
So you get an immediate, massive charitable tax deduction
Yeah.
that practically wipes out the income tax spike from the IRA withdrawal.
Exactly. You completely neutralize the tax bomb, and then the DF acts as your own personal charitable checking account. You can dole out that $50,000 a year to your charities over the next 5 years.
Wow.
You satisfy your philanthropic goals using the most toxic, highly taxed money you have, the inherited IRA. that allows you to keep your regular salary and your tax-efficient wealth safely in your own pocket for your family.
I love that. You're basically deciding which bucket of money gets used for which purpose based on its tax efficiency.
That's exactly it.
And what about charitable remainder trusts, or CRTs? How do those actually work?
A CRT is a brilliant mechanism if you want the charitable deduction but still need cash flow. You transfer the inherited IRA funds into this special trust. Because it's a charitable trust, it doesn't pay income tax when it empties the IRA.
Oh, that's huge.
Right. And you, the beneficiary, get a massive upfront tax deduction based on the estimated remainder the charity will eventually get. But here is the magic part. The trust pays you an income stream, an annuity, for up to 20 years or for your lifetime.
Wait, really? So you still get the money?
Yes, you stretch the tax impact out over decades instead of suffering through the government's 10-year fire hose. When you pass away, whatever is left in the trust goes to the charity.
That is incredibly clever. Now, if rerouting the money to charity or a trust solves the immediate income tax problem, what happens if you just want to keep the money outright?
Then we have to look at the secondary shockwave.
Right, because the damage doesn't stop at April 15th.
Yeah.
We have to talk about strategy 4, the Medicare trap, known as IRMAA.
Yes, IRMA. It stands for the Income-Related Monthly Adjustment Amount. It is essentially a hidden surcharge on your Medicare Part B and Part D premiums.
And the reason it catches so many retirees completely off guard is because of Medicare's 2-year look-back mechanism.
That look-back is vicious.
This is such a brutal delay. Walk us through how this feels for the taxpayer.
Okay, picture this. You are over 65. It's 2026. You take a massive distribution from your inherited IRA, you pay your income taxes, you grumble about the bill, and you think you are in the clear.
I paid my dues, I'm done.
Right. You go about your life through 2027. Then, in 2028, you open your mail and find a letter from Medicare stating that your monthly premiums are skyrocketing, potentially jumping by nearly $400 extra per month per person if you are married.
Wait, so over $4,000 a year in unexpected healthcare costs just because of a withdrawal you made 2 years prior?
Precisely, because your 2028 premiums are calculated based on your 2026 tax return. For a single filer, those IRMA thresholds start around $106,000. For a married couple, the initial IRMA penalty thresholds begin around $212,000 of income.
That is surprisingly low.
It is. If you aren't paying attention, a clumsy IRA withdrawal pushes you over that invisible line, and 2 years later, your healthcare costs explode. Proactive planning means keeping your AGI meticulously below those IRMA cliffs.
And beyond Medicare, for Strategy 5, we have to look at geographical escape routes.
Oh, state taxes.
Yeah, the guide specifically highlights the Florida advantage. Because up until now, we have only talked about federal taxes. But your state wants a cut too.
They always do.
Right. If you live in a high-tax state like California, New York, or New Jersey, state income taxes can add another 10 to 13% on top of the federal rate.
Which is just staggering.
Suddenly, that combined tax rate on your inheritance is pushing 50%. But if you relocate to a state with zero income tax, like Florida, Texas, or Nevada, before you start taking those massive distributions, you are legally bypassing that entire secondary layer of taxation.
The difference can literally amount to hundreds of thousands of dollars.
Easily.
If we connect this to the bigger picture, it illustrates how aggressive you have to be in defending this wealth. Sometimes the best defense is simply stepping out of the way. And that brings us to Strategy 6, the nuclear options, starting with a legal maneuver called disclaiming.
Disclaiming.
Yeah.
Which is formally refusing to accept an inheritance, which goes against every human instinct. I mean, why on earth would you refuse free money?
Because of the collateral damage to your own tax profile and the opportunity to protect the family's total net worth. Let's imagine a highly successful 55-year-old executive inherits an IRA from their mother.
Okay.
They are already in the highest possible tax bracket and paying maximum Medicare surcharges. Every dollar they take from that IRA gets decimated by taxes. But if they legally disclaim the inheritance, the asset bypasses them and flows to the contingent beneficiary named on the account.
So if the contingent beneficiary is the executive's 24-year-old child who's in graduate school, making practically no income.
Exactly. The graduate student is in a microscopic tax bracket. They take the distributions over 10 years and pay virtually zero taxes on it. The family unit retains vastly more of the original wealth.
Oh, wow. That's a massive wealth preservation tool.
It is, but the mechanism of disclaiming is extremely strict. You have exactly 9 months from the date of the original owner's death to file the paperwork. And you cannot have accepted a single dollar of benefit from the account beforehand, not 1 cent.
Yeah, and 9 months goes by in an absolute flash when a family is dealing with grief.
It really does.
And speaking of nuclear options to protect wealth, Strategy 7 covers estate defenses. We have to talk about estate taxes because the laws are changing fast. Right now, the estate tax exemption is very high, but in 2026, it is scheduled to drop down to roughly $7 million per individual.
This creates a double taxation nightmare.
How so?
Well, if you are already wealthy, inheriting a massive IRA might push your total personal net worth over that new $7 million limit. So think about the timeline. First, you get crushed by income taxes over 10 years trying to get the money out of the IRA.
Right.
You put the remainder in your bank account. Then, when you eventually pass away, the IRS comes back and hits whatever is left with a 40% estate tax.
40%. It's brutal. So how do these mechanisms like ILETs, irrevocable life insurance trusts, or dynasty trusts actually solve this? Like, how do they shield the money?
The mechanism of an ILET is fascinating. Instead of letting the wealth sit in your taxable estate, you use the distributions from the inherited IRA to pay premiums on a life insurance policy.
Okay, buying insurance with the IRA money.
Right. But crucially, that policy is owned by the irrevocable life insurance trust, not by you. Because the trust owns it, the death benefit is completely removed from your estate.
Oh, that's fine.
When you pass away, the trust pays out millions of dollars to your kids, completely free of income tax and completely free of the 40% estate tax. You have effectively washed the taxable IRA money into tax-free legacy wealth.
Okay, but bringing up trusts opens up a massive gotcha in the Davies Guide. Because using a trust seems like the responsible thing to do, right? You want creditor protection, or maybe you want to ensure a younger beneficiary doesn't blow the inheritance on a Ferrari.
Sure, very common.
But the guide includes a severe warning from Fidelity about using accumulation trusts for IRAs.
It is a staggering trap. To understand why, you have to look at how trusts are taxed compared to individuals. An accumulation trust is designed to take the mandatory distributions from the inherited IRA and hold on to the money, accumulating it inside the trust rather than handing it directly to the beneficiary.
Okay, so it protects the capital.
Exactly, it protects the capital, but the IRS penalizes this heavily by compressing the tax brackets for trusts. An individual doesn't hit the top 37% tax bracket until they make hundreds of thousands of dollars.
Right, we established that earlier.
An accumulation trust hits that maximum 37% penalty rate at just over $15,000 of income.
Wait, just $15,000?
Just over $15,450 in 2026.
Oh my gosh.
So if the IRA forces a $100,000 mandatory distribution into the trust, nearly $85,000 of it is taxed at the highest possible federal rate. If you have an old estate plan that defaults an inherited IRA into an accumulation trust under these new Secure Act rules, you are willingly walking into a slaughterhouse.
That is terrifying.
It's one of the biggest mistakes we see.
Well, here's another very human gotcha the guide points out: multiple beneficiaries. Let's say a parent leaves a single IRA to two siblings. One is a 50-year-old high-earning executive, and the other is a 20-year-old college student. The law says the account must be formally, legally split into separate inherited accounts by December 31 of the year following the death.
Correct.
What happens if they miss that paperwork deadline?
It's catastrophic for the younger sibling. The IRS rule is that if the account isn't split, the beneficiary with the shortest timeline and the strictest rules dictates the tax reality for everyone.
No way.
Yes. The 20-year-old is forced to adhere to the timeline and tax pressures of the 50-year-old. A simple administrative delay can literally cost a sibling hundreds of thousands of dollars in lost tax deferred growth.
Wow. Which perfectly sets up the biggest plot twist in the whole guide.
The Roth reversal.
Yes. Because everything we've discussed so far, managing brackets, giving to charity, avoiding trusts, all of that is based on inheriting a traditional pre-tax IRA. But the mechanics flip entirely when we look at inherited Roth IRAs.
They absolutely do.
Here's where it gets really interesting. If a traditional inherited IRA is a ticking time bomb you need to carefully diffuse year by year, an inherited Roth IRA is like a financial pressure cooker. You want to let it build up tax-free flavor until the very last second.
I love that pressure cooker analogy because the Secure Act's 10-year rule still applies to Roth IRAs.
Okay, so you still have the 10-year limit.
The government still demands that you empty the account by the end of year 10. But here is the massive difference. Roth distributions are tax-free. They don't spike your AGI. They don't trigger RMDs surcharges.
So no Medicare penalty?
None. So the strategy is a 180-degree reversal. You do not want to spread withdrawals out over 10 years. You want to leave every single penny inside that account until December 31 of year 10.
Just let it ride.
Let it experience a full decade of tax-free compound growth. You are maximizing the most powerful asset the IRS allows.
Which transitions us perfectly to the final piece of the puzzle, proactive planning. Because we've spent this entire time talking about how to survive if you are the beneficiary receiving the money.
Right, the recipient.
But what if you are the listener who actually owns the IRA right now? Like, what can the original owner do today, before they pass away, to save their kids from this 10-year tax bomb?
The most impactful legacy planning happens while you are alive and healthy. The Davies Guide outlines aggressive pre-death actions. First, doing your own Roth conversion ladders now.
Paying the tax up front.
Exactly. Pay the tax today at a known lower rate so you leave your kids a tax-free pressure cooker instead of a tax bomb. Second, stacking qualified charitable distributions, or QCDs.
How does that work?
If you are over 70 and a half, you can send up to $105,000 in 2026 straight from your IRA to charity, shrinking the taxable bomb your kids will eventually inherit.
But the guide stresses that the single most destructive mistake people make isn't about failing to set up a complex trust. It's failing to update their beneficiary designations.
That is the number one issue, because beneficiary designations on a financial account legally override a will.
Wait, they override a will?
Completely. It does not matter how beautifully drafted your last will and testament is. Whoever is named on that specific IRA form gets the money.
Oh, wow.
If you named an accumulation trust on that form 15 years ago thinking you were protecting your kids, that outdated piece of paper will override your current wishes and trigger that 37% trust tax trap we talked about earlier. You have to review those designations annually.
And let's remind everyone of the stakes if a mistake is made. If a beneficiary gets confused by all these timelines and fails to empty the account by the end of the 10th year, the IRS imposes an excise tax of 25% on whatever is left in the account.
A quarter of the account just gone.
Now, the guide notes, it can sometimes be reduced to 10% if you correct the error quickly, but you do not want to hand over a quarter of your remaining family wealth just because you lost track of a deadline.
It proves that the era of passive wealth transfer is over.
Completely dead. Managing an inherited IRA today is a highly customized, multi-year, proactive defense operation. You are fighting on multiple fronts. You've got federal brackets, state taxes, Medicare surcharges, and estate limits.
It's a lot to handle alone.
It is. And if you are navigating this, remember that our source today, Davies Wealth Management, offers a complimentary fiduciary audit, and you can download their Medicare IRMAA planning guide to chart your course.
We've spent this entire deep dive dissecting the mechanics, the tax brackets, the trust rules, the IRS code. But I want to leave everyone with a thought about the invisible human element this legislation creates.
Okay, let's hear it.
Think about the psychological impact on a family. If an outdated beneficiary form overrides a will and a massive 10-year tax bomb is unexpectedly dropped on one sibling who is a high earner, while another sibling in a lower bracket pays almost nothing, how does that alter the promise of an equal inheritance?
Wow, that's a great point.
This 10-year rule isn't just a tax problem, it is a catalyst for family resentment. It fundamentally forces families to communicate about the structure of wealth while the parents are still alive. Have you had that uncomfortable but absolutely necessary conversation with your family yet?
Oof. That is the million-dollar question. Because the government swapped out the garden hose for a fire hose, and if you aren't talking to your family about who's going to hold the hose, someone is going to get knocked over.
Exactly.
Well, thank you all so much for joining us on this deep dive. Keep asking those big questions, check those beneficiary designations, and we will see you next time.